Welcome to the Prosperity Health GP series. As accountants and financial advisors who specialise in the medical industry, we recognise that many of our clients are time poor and also find it difficult to be available during office hours. So for this reason, we've put together a short series of videos which address the common questions that we field from our clients, which will also help you run your practice and control your wealth. In today's video, we'll be looking at the subject of investing outside your practice. So Gary, when medical professionals are considering where to invest any surplus funds that they might have, should they invest those funds within their practice?
No, Stephen, it'd be more sensible to invest your monies through a separate structure to hold your passive investments.
So why is that important?
It's important because if you held your passive investments within your business and in the future at some stage there was business risks such as the business being sued for whatever reason, then your passive investments would then be at risk.
Okay, so if they're not holding their passive wealth within their practice structure, where should they be holding their, what are the options available to them as to where they hold their wealth?
So there's four main options as to where you hold your wealth. Firstly, you can invest in your personal names. So this could be an advantage in the situation where you've got a spouse who may not be working or is on a low marginal tax rate. So for example, if they're earning less than $39,000 a year, they might be on a tax rate of only 19%. So it might be worthwhile holding some investments personally in their name. Secondly, you can invest through a family trust structure. So the advantages of a family trust structure is that you're able to distribute income to a range of beneficiaries, often family members who are on a lower marginal tax rate. Thirdly, you can invest through a company. Companies are generally taxed at the rate of 30% on investment income. The only disadvantage of investing through a company is that you don't get the 50% discount on capital gains. And then fourthly, there's the superannuation environment to invest through. Superannuation will generally provide the most tax-effective outcome for investors just due to the fact that the tax rate in super is only 15% on investment income. However, when investing through super, it's really important to take into consideration what your preservation age is. Your preservation age is the age at which you can start to access capital from your super. And this is generally around age 55 to 65 for most of us. And if you're more than 10 years out from reaching your preservation age, I'd say it's a sensible strategy to maintain some of your passive investments outside of the superannuation environment in case you need to access capital.
Okay, so once the issue around what structure they should invest in has been addressed, what should a GP be thinking about in terms of the kind of assets in which they could invest?
Yeah, so I think the first factor to consider is the time horizon from the investment. If you're looking to invest into growth assets such as property and shares, you really need to be looking at a longer term time horizon of more than 5 years. And then secondly, diversification is so important in a portfolio. Diversification is a way of reducing risk. History tells us that no single asset class has consistently outperformed other asset classes over a long period of time. So diversification is important.
So what would be the main asset classes that a medical practitioner should consider when they're trying to diversify their investment portfolio?
Yeah. So the main asset classes that we look at for our clients when constructing portfolios, firstly, defensive assets. They're basically designed to provide regular income to investors, but also provide your portfolio with downside protection when growth assets become volatile. So the main assets we go into are bonds and fixed income assets. And then secondly, you've got growth assets, which are designed to provide long-term capital growth above the inflation rate. And generally there we look at a mix of Australian shares, international shares, property and alternative assets. So it's really important that in a portfolio you not just diversify across asset classes, but you also diversify within asset classes. So by combining your growth assets, which will provide long-term capital growth, with your defensive assets, which will provide downside protection, it should reduce the risk in your portfolio.
I met a lot of GPs, Gary, who have a very high proportion of their investments all tied up in direct property. Why is that?
Often it's because GPs will own the family home, they'll own the business property that they're running the practice out of, and throw in there one or two investment properties, and that can often lead to a very overweight or heavily weighted position in direct property.
So Gary, what are the advantages and disadvantages of being heavily into direct property as an investment class?
So I think the main advantages of investing in direct property is firstly, property is not priced on a daily basis. So unless you actually put the property on the market to sell, you're not going to know exactly what the price of it is. Secondly, with direct property, you've got full control over the asset. Given that you're the sole owner of the property, you have full control over all the investment decisions. And thirdly, with direct property, you can get some quite attractive rental yields, particularly with commercial property, where yields can range from sometimes 5 to 7%. So that's quite an attractive return. The main disadvantages, I think, with direct property, firstly, residential property yields can be quite low. So residential property, often the yield can be as low as 2 to 3% per annum. Secondly, property is not a liquid asset. So if you want to sell the property, you can't sell part of it. Obviously, you've got to sell the whole asset. So if you need to access capital, that can be a disadvantage. Thirdly, your source of income in a direct property often comes from one tenant. So there can be risks there that if the property was untenanted, that you may not have income flowing through. Fourthly, direct property, there can be quite high costs of getting into the asset to begin with, such as stamp duty and legal costs. And lastly, with direct property, often the risk of the investment is tied to one specific asset. It's not diversified, so there can be some higher risk in there.
So do you have any tips for our direct property investing clients?
Yeah, so I think the main things to consider are firstly, the fact that you don't want to buy a whole range of properties in the one area. You want to make sure that you diversify your property over a range of different areas to reduce the risk. Secondly, you want to make sure that you're claiming all the tax deductions on the property, so depreciation and expenses are being claimed. And thirdly, you just want to make sure that the idea of the investment is for long-term capital growth, that it's not to generate income.
So most of our medical practitioner clients are on quite high tax rates. So should they be considering gearing as an option for them as part of their investment portfolio?
Yeah, so it's a good question, Stephen. Gearing is basically borrowing for investment purposes. Generally with gearing, you have a property which acts as security for the loan. And when you take out the loan for investment purposes, the interest is generally tax deductible. But it's important with gearing that the main focus is long-term capital growth. So it wouldn't really make sense to gear into defensive assets. You really have to be gearing into growth assets. Therefore, it's really important that you diversify your assets. Now, given that a lot of medical practitioners are on high marginal tax rates, gearing is a better strategy when you want a higher tax rate, and that's due to the fact that you get a larger tax deduction for each dollar of interest that you pay on the loan. However, it's important to note with gearing that you need to be comfortable with the concept of borrowing for investment purposes.
So are there some key risks associated with a gearing strategy?
Yeah, so the main risks are firstly, because the investment's being funded through borrowing, the gains and losses can be magnified, so your returns can be more volatile. Secondly, with gearing, it's important that you have a comfortable cash flow position because interest rates can go up and down during the period of the investment, so cash flow needs to be comfortable. Thirdly, it's important that you have appropriate insurance cover in place. So, for example, you want to have income protection cover and total and permanent disablement cover in case you weren't able to work, so you can maintain your geared investment. And also, it's important to note that one day that loan will still need to be repaid, so that will either come from the sale of the investment or it might come from other cash proceeds.
Okay, so how would you summarise your thoughts on the subject of why it's important to invest outside your practice as a medical practitioner?
Yeah, I think it's important. You don't want to rely on your medical practice to be your nest egg for retirement. Even though the practice from year to year might be highly profitable, when it comes to the stage where you're ready to retire and if you want to sell the practice, who knows what sort of price you'll get for the practice in the market. So I think it's really sensible that you try and build your passive investments in a diversified manner, as well as obviously your business as well.
So thanks, Gary. I'm sure it's just important to note at this point that the advice we've been getting from Gary has been of a general nature only, and it's very important that you seek personal, tailored advice in relation to your own circumstances from your financial advisor. Well, I hope you've enjoyed this episode of the Prosperity Health GP video series. If you'd like to find out more information or see the other videos that we have available in this series, please go to our website, prosperityhealth.com.au, where you can also find contact details for our team. Thank you.